The dollar yen is trading above the 156 level this morning after the Bank of Japan didn't say much regarding its intention to intervene. Now, across the Pacific Ocean, US indices were pressured down yesterday by a 10% sell off in Meta and a less than ideal GDP report from the US, which actually revealed a slowing US economy but persistent inflation. Happily, quarterly results from Microsoft and Google impressed investors and sent their stock prices higher in the after hours trading. Now, all eyes are on the US Core PC index and oil giants' earnings this Friday. So, welcome. This is Swissquote's daily market talk. Yes, we knew that yesterday was not going to be a piece of cake for risk traders as we started the day knowing that a giant would stumble. And indeed, Facebook's Meta went on a 10% free fall at yesterday's trading session, even after the company announced better than expected earnings the day before. This being said, yesterday's sell-off in Meta ended up being less than the one we saw in the after-hours trading. And the CEO, Mark Zuckerberg, said that, well, in the past, the company also experienced a high price volatility during a period of high investment when the results were not visible yet. And many investors out there think that Meta could successfully turn its AI investments into profit. It's just that it will take a bit longer than many expected. So all in all, some investors think that Meta is worth buying at the dip. The question is, where is the dip, right? Because even after yesterday's 10% sell-off, well, Meta is up by more than 50% since this year started and up by more than 500% since November 2022 dip. So it's your call. Where is the dip? Now, one positive news yesterday was that Meta didn't pull the rest of the technology stocks down with it. Nvidia, for example, gained more than 3% at yesterday's trading session, while Tesla jumped another 5%. Don't ask me why. On the macroeconomic stage, well, the news were not bright at all because the first estimate for the US first quarter growth showed that the US economy actually slowed in the first quarter of this year. Yet this time, it just slowed way more than expected by analysts. My eyes actually popped when I saw the 1.6% GDP print yesterday versus 2.5% penciled in by analysts and 2.7% hinted by the famous Atlanta Fed GDP now. So the GDP number came as a big downside surprise. Now, a bad number could have at least revived the dovish Federal Reserve expectations, but that notable jump that we saw in core PC prices to 3.7% from 2% printed a quarter earlier, well, didn't give much room for optimism. So, yesterday's GDP data threw a wrench into the soft landing dream and, well, sparked fears of stagflation in the US, where the economy would slow down while inflation persists, which would actually force the US Federal Reserve to keep its monetary policy tight. So the US 2-year yield continues to test the 5% psychological mark to the upside as the 10-year paper yields near the 4.70% level. Bill Gross said this was the day the music died and asked why on bonds with the 10-year yield moving to 4.75% level. Stick to value stocks and avoid technology for now, he said. Now today, all eyes are on the US core PC print for March, which is expected to decline to 2.6% from 2.8% printed a month earlier. Now, the fear is to see a higher inflation print than expected, of course, which would further better the Federal Reserve's rate cut expectations. But the good news here is it looked like yesterday's price action after the GDP report embedded today's core PC print already into it. So the bad news are at least partially priced in, which gives room for, well, a positive surprise before the closing bell. But before I move forward, it's still worth diving a bit deeper into yesterday's GDP report, because the slowdown that we saw there was mainly caused by a lower inventory accumulation and a wider trade gap. But a gauge of underlying demand still came in above 3%, and that for the third straight quarter, which also explains why we see inflation persist in the US while the headline GDP slows down. So, in summary, this whole thing means that it looks like the inflation, which slowed last year thanks to the fading post-pandemic boost to prices, is now fueled by still robust demand. And that's something that the Federal Reserve could actually address by, while keeping its monetary policy tighten up. So, swap traders now price in a 35 base point cut for the entire 2024. That's down from 6 rate cuts priced in at the start of this year, remember. So that's a huge change, and it's clearly not excellent news for your regular risk assets. But happily, big technologies probably got our back, at least for today's trading session, given that both Microsoft and Google's Alphabet jumped in the after hours trading yesterday after, announcing sufficiently strong quarterly results that met and surpassed analyst expectations. Because Microsoft gained more than 4% after announcing better than expected sales and better than expected profit, thanks to robust corporate demand for its cloud and AI offerings, while Google jumped 11% in the after hours trading, boosted by its own cloud business. Nasdaq futures are up by more than 1% at the time I'm talking here this morning, and the session looks good. In the FX, the US dollar index is slightly better a bit this morning as the dollar yen shot above the 156 level this morning after the Bank of Japan decided to leave its interest rates unchanged. Now, this decision was expected. The BOJ even lifted its 2024 inflation forecast from 2.4 to 2.8%, but in vain. The lack of a clear hawkish message and the absence of intervention news so far, gives confidence to the yen bears, and Bloomberg predicts that 157.60 level could be a key level to watch based on an analysis of comments from Masato Kanda, they say, who is a top currency official at Finance Ministry in Japan. But we also know that we all have our eyes set on the 160 psychological level. Now, elsewhere, the euro and sterling retreat this morning against a broadly better bid US dollar following this week's rebound. US crude, on the other hand, recovers past the $84 per barrel level despite the US GDP disappointment yesterday and the further decline that we saw in Federal Reserve's rate cut expectations. Now, note that the geopolitical risks remain tilted to the upside as Israel is said to be preparing for an all-out war with Iran-backed Hezbollah. And on the corporate front, Exxon and Chevron are expected to announce their first quarter results today. And note that despite the rising crude oil prices, both companies, both Exxon and Chevron, are expected to report a decline in their first quarter profits compared to the same period last year, and that's due to a global glut in natural gas supplies and narrower refining margins. But if all goes well, and if crude prices continue to climb, the energy giants' fortunes could actually reverse in the second quarter of this year. So Exxon closed yesterday's trading session above the $121 per share level as Chevron climbed past the $165 per share level. But note that while the reflation trade is expected to boost appetite for energy companies, an unwelcomed return of inflation may also put this reflation trade on hold. So that's my last word for this week. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.